Howdy who, all my stock market gamblers. Welcome today. It's Monday. Market's back open and the market's booming. The Dow's up almost 500 points. We're getting that bounce off of the lows. Buy the dip mentality is still out there. And yes, I do think you should still be buying the dips because that's the mentality that's going on right now. This is a bubble, but you can blow the bubble up bigger. Now this, in my opinion, is the mother of all bubbles. Now how did we get this way? Well, we get this way with debt. Debt is at record highs. Now, there's one type of debt I want to talk about right now, which is margin debt. Margin debt is at a record high. It just hit a new record again. It keeps increasing. It's 860 billion. It's going to hit $1 trillion, I bet. Margin debt. Now, what happens when margin debt's at a record high? Tells you we're almost at the end. Tells you we're almost getting ready to pop this bubble. Look at margin debt was at a record high in 2000 with the NASDAQ bubble. What happened? Got popped. Margin debt was at a record high in, 2008, right before the great financial crisis. Okay, what happened? The bubble popped. Margin debt is again at a record high. What's going to happen? Well, the bubble's going to pop. Now, how do I know it's a bubble? Mike, it's not a bubble. It's just the stock market. Stock market only goes up. It doesn't go down anymore. Well, it is a bubble. You can look at a lot of indicators. A lot of people look at what's called the PE ratios. Okay, now in the S&P 500, the PE ratio right now is running about 44 on average. What's normal? About 17 to 20. We're at 44, 17 to 20 is normal. All right, Warren Buffett has the indicator of GDP. Anyways, we're at 233% right now of the GDP. Okay, so that's the Warren Buffett indicator. What's normal? About 100%. Okay, so both of these indicators are showing us massive bubble. Now what happens with the massive bubble? Well, eventually a crash happens. Now how does the crash happen? Well, could happen a lot of different ways. What if interest rates spike? People don't think that can happen. No one thinks interest rates could spike higher. We've seen it in the repo market before. It can happen again. Anyways, interest rates can spike higher. Now, what happens when they spike higher? Well, people, they can't afford to pay the debt. They can't afford to pay the loans. So they get liquidated. They sell off. Then the market comes down when they sell off. Okay, they sell off. Market comes down. And then there's more liquidation, okay, because people get underwater at that point and they get what's called the margin call. When you're out there trading on all this margin debt, you get margin calls when the market comes down, and that perpetuates the sell-off. This mother of all bubbles is going to result in the mother of all crashes. It's just the way it works. It's a natural course. Anyways, what we have is we have people taking out leverage on their portfolios, okay, in the stock market. Some people are trading at 10 times leverage. I mean, they have $10,000 and then they buy $100,000 worth of stock. Now, this leverage, it spreads out more than just the stock market. It spreads out even into the housing market. A lot of people are taking out loans against their stock portfolio to buy houses. Now, if their stock portfolio goes down, they're going to need that money back. So what does that do? They would have to sell that house to get that money back to put it into the market again. So this debt leverage, it can bring all bubbles down, not just the stock market bubble. It can bring down the housing bubble. It can bring down the bond bubble. It can bring down the crypto bubble. We're all in the bubble, and this is all because of the Fed. The Fed keeps printing money. They've got $8 trillion on their balance sheet. They're headed to double this again. They're going to get to $16 trillion. All right, today I talk to people, and it's funny. It's like, let's talk about the Reddit gang, I mean, in the days when I was studying economics, I was an economics major. I was studying economics, and 7 or 8% return on your money was a good thing in the stock market. It continually did that year after year. 7, 8% is what it averaged. People today, they don't want a part of 7 or 8%. They want to double their money next week. They want to take 10,000 and turn it into $1 million by the end of the year. They trade in options, they're trading derivatives. Now these derivatives are incredible. There's derivatives, which an option is. An option is a derivative on a stock, okay? You can have derivatives on a lot of different things, but you can have derivatives even on a derivative. And these derivatives, there's hundreds of trillions of dollars in derivatives in the market. And some say as much as a quadrillion in derivatives. The financial stress that's going to happen when the crash finally comes. Now, we're not there yet. We're not there. We're getting close, though. I do think we're getting really close. We'll see. Maybe the Fed can keep printing, keep propping. We'll see, but we're getting closer to the end. But you have to trade this market. You have to, as a trader, I'm a stock market gambler. You want to buy these dips right now. You still want to buy these dips. How long will that go on? I don't think that much longer, but this dip we're seeing right now, yeah, you want to buy it. You want to buy it. Is the market going to come down anytime soon? It's getting close. Okay, another thing. There's what's called zombie companies. What's a zombie company? A zombie company is a company that has so much debt that they don't bring in enough cash flow into their business to even pay the interest on their debt. So the only thing they could possibly do is borrow more money to stay alive. They have to borrow more money to stay alive. They have so much debt, they don't bring in enough cash flow just to pay the interest. It's a zombie company, so they have to borrow more. Now, what's kind of funny is the United States is becoming a zombie country. Pretty soon we're not going to bring in enough money to even pay the interest on our debt. If interest rates spike up, it's going to be a big problem for the United States. They're going to have to print unlimited money. Now, inflation can go one of two ways. All right, so we can keep printing money, crash the dollar, and send inflation up. Now, what should you be in under this scenario? Should be in gold, silver, cryptocurrencies, Bitcoin. Anyways, those will protect you against the dollar burning. So the printing of money, they're going to burn the dollar. You have to protect yourself, gold, silver, and Bitcoin. Now, the other way they could go is they could stop printing money. Stop printing money and raise interest rates. Wow, wouldn't that be interesting? What do you want to be in then? If you believe that's the scenario, you want to be in cash. You know why you want to be in cash? Because everything's going to crash. Everything's going to break. And then you can buy stuff for pennies on the dollar. So cash can become king if they stop printing money and raise interest rates. Now, right now, I don't see that happening. I think it's a free-for-all. I think they're going to print as much money as they can. I don't think Biden has any plan to cut spending. He wants to spend more and more. He wants to give free cars to people, free houses to people. I think we're starting universal basic income. I heard that. We're starting UBI. We're doing a test market right now in New York. They're giving families $500 a month for a year. It's a test market. It's coming all over. It's going to be here. Universal basic income, where they just send you money in the mail. We kind of have a little bit of that now with the unemployment. You get that extra $300, right? Okay, that's free money in the mail. Okay, and that's going on right now. We're going to get more of that. But back to zombie companies. Zombie companies in the S&P 500, well, normally you'd have about 2% zombie companies. Be like 10 companies out of 500. That'd be normal. Right now, it's running about 20% of the S&P 500 are what's known as zombie companies. 20%, that's like 100 of the 500 companies are zombie companies. These are companies that can't pay their debt. Zombie companies. Now, the reason you have recessions and crashes in the market is to get rid of the zombie companies. Zombie companies are not good for our economy. They're really not. They're sucking resources, but they have a bad business model, and those resources could go to good companies that can pay their debts, that can make money. You don't want zombie companies running around. Not 100 out of the S&P 500. That's just wrong. That's why you want the pullback in the market, and you're going to get that pullback, just not yet. You're going to to get the mother of all crashes is coming. Just not yet. Right now, it's just the mother of all bubbles. Mother of all bubbles we're living in. It's caused by debt. And soon, that bubble's going to be popped. I guarantee it. But right now, it's still print money, print money, print money. And that's going to continue. So buy the dip. That's my opinion right here. And we'll see what happens. If you like this stuff, give me the thumbs up. Why not? If you really like it, hit that subscribe button so we can talk more. We're going to see what happens later in the week. This could be a very volatile week. We'll see. But just buy the dips right now. But keep listening, because pretty soon it's going to be time to start to short this market, and you can make a lot of money on the downside when this bubble pops. I'm Tall Mike. Get out there. Have a great Monday. We'll talk again soon. Bye-bye now.